The big difference is that the average American is looking to buy one of these homes. But the more that us average Americans wait, the more these institutions wait. When they feel it's a good time to buy, they're already going to be way ahead of regular people like you and me. And they're going to know, okay, this is the time, let's do it, let's invest. Hey guys, welcome back to the YouTube channel. So in today's video, we'll be reviewing 3 articles that I find could be helpful to gauge how the real estate market's behaving and where we could be headed. These articles are going to be from Yahoo Finance, Redfin, as well as Fortune. And these articles today will talk about the perspective from home buyers and sellers and where the market currently sits. We'll also be talking about builder sentiment to get an idea of how the builders are feeling about the upcoming market. And we'll also be able to look at the institutional side of things to figure out where investors are parking their money and when they might actually be looking to pick up and buy more real estate. So if you find the information and content in today's video helpful, please go ahead and drop a like down below. And of course, I'd love your guys' feedback on any of these articles and any input that you have. So again, feel free to leave a comment also so I understand exactly the perspective you're carrying. And it might also be useful for others who are coming in and trying to learn more about the market as well. So let's go ahead and without further ado, jump into the first article. So this first article from Redfin. New listings of homes for sale are down 25% from a year ago, marking the 8th straight month of double-digit declines. That's making it difficult for buyers to find homes, but giving sellers a competitive edge. So what this is telling us is that we've seen 8 months consecutively of declines for new homes for sale. The new listings of U.S. homes for sale dropped 25% from a year earlier, continuing an 8-month streak of double-digit declines. That's the biggest drop since the start of the pandemic, but of course there was a holiday weekend effect, as they note here in the article. People are reluctant to sell because they don't want to give up their low mortgage rate. It's hard to find another home to buy, and many Americans recently moved. Although rates are down from the November peaks, this week's average is 6.27%, and 85% of homeowners have a rate far below 6%. So if you think about 2020, when stimulus started to come into the economy to help during the pandemic, there was really cheap money available for people to borrow and buy real estate. Now, as a result of that, what we're seeing in the market today is that these last few years of low interest rates made it where 85% of homeowners are below 6%. So if you're a homeowner and your mortgage rate is below that 6% mark, you really don't have incentive to sell your home and move in a scurry, right? And also for people who want to buy real estate, even as rates start to come down, the limited inventory is a challenge right now, which they'll talk more about in this article. But really easy math would suggest that if 85% of homeowners currently have a rate less than 6%, what incentive and what motive is there to really sell your home? As long as interest rates remain this high, if you're going to get another mortgage on a new place, you're going to be paying a way higher interest rate. So this is why we're seeing a lot of issues with inventory rising. We're not really seeing a rise of inventory like we expected. And of course, you have to take that into consideration. The bright side for homeowners who are listing now is that desirable, well-priced homes are being snapped up in bidding wars in markets where demand outpaces supply. So in certain markets, especially some in Florida, Tennessee, other areas, you're seeing that there are a lot of bidding wars and multiple offer situations, and the demand is outpacing what's available for people to buy. So that's causing another stir in the market where it's leaning towards a seller's market and giving sellers a very big advantage. New listings fell from a year ago earlier in all 50 of the most populous U.S. metros, with the biggest declines in California. They dropped most in Sacramento and Oakland, minus 47% year over year apiece. San Francisco, minus 43.2%. San Jose, 42.9% under. And San Diego, 41.4% under. The scarcity of homes hitting the market, along with elevated mortgage rates, is holding back sales. Pending home sales dropped more than 30% in each of those metros, more than 19% nationwide decline. So Pending home sales in each of those metros down 30%, but in the rest of the country, we're looking at a 19% nationwide decline. So most of these declines, the big bulk of them, the harder part of them are happening over on the West Coast, especially in California. While pending sales are down, early stage home buying demand is kicking up, with mortgage applications up 8% from a week earlier. Of course, this is seasonally adjusted. And, that's a good indicator, guys, of where the market could be going, right? If buyer demand hasn't necessarily slowed down, but rather it's actually starting to tick up and increase, and with still limited supply, where does that leave us with home prices? Depending on the area you're in, especially an area like Florida where I'm located, that means that we're going to see home prices continue to go up. So buyers have to be very cautious. They're waiting for the market to crash. But if it's not happening in these types of areas where the markets are hot, it seems unlikely it'll really happen at all. Angela Langone, a Redfin agent in San Jose, said there aren't enough listings to go around with multiple offers on many homes. Both new listings and pending sales are down more than 40% from a year ago in San Jose. Many buyers here aren't being held back by high mortgage rates. It's the lack of inventory that's really getting in their way. I have several clients who are serious about buying a home, and they are actively looking, but they cannot find anything right now, and they're being patient. They're waiting for more homes to trickle onto the market. So again, another situation where people might be ready to buy. The interest rates may not necessarily be keeping them away, especially as they've started to decline these last few months, but the lack of inventory will make it very difficult for people to be able to buy real estate. It's going to be very hard to get into this market when there's not really many homes available for you to choose from, and that leaves you having to fight over homes with other potential buyers. Buyers have more options in other parts of the country. In Nashville, Tennessee, for instance, new listings and pending sales were both down about 14% from a year earlier, but those are some of the smallest drops in the country. Inventory isn't a major problem here because the greater Nashville area is so sprawling and there are a lot of newly built homes on the market in the suburbs. And as it goes on to say here, builders went big in the outskirts of the city over the last few years. Now they're offering incentives to attract buyers to the point where individual sellers are having a hard time competing. For buyers willing to stray from the city center, there are plenty of homes for sale. And I think this is a key part too. Over in Florida where I'm at, there's a lot of builders and a lot of new developments coming around, especially in Venice and Northport and Port Charlotte. And seeing the uptick of builder activity is leading us to believe that builders are going to have the upper hand. Not only will they be able to supply inventory to the market, but they're also going to be able to offer incentives for people to want to buy from them rather than buying from that person that lives maybe, in the middle of Northport who owns their home and they're trying to sell it with an agent or on their own. There's a lot more incentive to go to new construction right now. They'll help with seller concessions, they'll cover closing costs, and they give you additional bonuses and incentives to financing and buying with them. So that's leaving a lot of smaller sellers in a peculiar situation where it's actually really hard to compete with these big institutions and these big buyers. And they go on to say here, 2 new pieces of economic data serve as tea leaves we can read to anticipate how mortgage rates will trend over the next few months. It's unlikely they'll skyrocket, but it's also unlikely it'll come down enough to motivate locked-in homeowners to sell. The March Consumer Price Index report and jobs report showed that inflation continued to cool and wage growth ticked down from the month before, but inflation is still higher than the Fed's target. So guys, even though interest rates may continue to rise, and even if they don't, right, like the odds of it skyrocketing are unlikely because inflation has started to come down. The Federal Reserve is seeing numbers that they want to see, and that's starting to lead them to lower and lesser increases. And we will get to a point, hopefully soon, where the Fed decides to pause the interest rate hikes, which could be a good indicator for where the market goes next. But it's also important to understand that even as rates may tick down, it's going to be still very, very hard for people who have low interest rates to find incentive in actually selling their homes. So we could be left with quite a drastic inventory issue for quite some time. especially if these interest rates just continue to stay at a moderate level where they're at today, there's really less incentive for people to sell. So it's going to be really interesting to see what happens over these next few weeks and months, and especially over the next few years. So guys, give me your comments down below and let me know what you think about this. Do you think that the housing market is still due for some sort of correction? Have we already seen a big part of the correction, seeing that parts in California are down around 40%? Or is there still more pain ahead? Let me know down in the comments below. And of course, if you found this video helpful today, please go ahead and drop a like, as I look forward to continue to doing more updates and article breakdowns just like this. If you enjoy this type of content, I also have a free newsletter that you can subscribe to. And you can get up-to-date information just like this, where I break down articles and talk a little bit more about where the market is, especially in my local area. So again, guys, thank you so much for the love and support. Please drop a like, and I look forward to seeing you guys in the next one. Peace. Next one. All right, so this article is by Danny Romero of Yahoo Finance. She's a reporter over there, and she just wrote this article today as recording this video. Housing, home builder sentiment rises for fourth straight month as housing steadies. Confidence among U.S. single-family home builders climbed in April, the fourth straight month this measure has increased, as declining mortgage rates and low inventory bolstered demand for new homes. The National Association of Home Builders, Wells Fargo's gauge of builder sentiment, rose 1 point to 45, according to figures released Monday, matching Wall Street expectations. This measure still reflects general caution among builders as we head into the heart of the housing spring selling season. Readings under 50 for this index show a larger proportion of builders responding to the survey sees conditions as poor than those conditions in the market as good. So, just to go over what this really is talking about here, there's been, because of how rates have increased and because of how home prices have come down in specific areas, a lot of home builders were a little bit skeptical of what that means for them, right? You know, there's still a very low amount of inventory nationwide. We're still in a little bit of a housing crisis in the sense that there's not enough homes available to meet buyer demand. But a lot of home builders are trying to get an idea of what this means, because back in 2008, 2007, 2006, there were way too many homes being built due to the speculation of the market and also due to insane lending practices that benefited nobody and led to a giant financial crisis. So what home builders are trying to figure out is, you know, where does this leave us? Are we in a situation that's similar back to 2006, 2007? Or are we in a situation where hopefully we can come in and actually take a big piece of the market share in finding these buyers that need homes, right? Because, you know, there's not enough people selling their homes. We read an article earlier, 85% of home buyers are actually under 6% on their interest rate. So there's really not a whole lot of incentive for people to sell their home, get a new mortgage, and have a higher interest rate than what they currently have. So they provide this chart, and this is the National Association of Home Builders and Wells Fargo's gauge of housing builder or home builder. So this is the National Association of Home Builders and Wells Fargo's gauge of home builder sentiment. And we see that there continues to be a rise in this year, but let's break down the entire chart. So this dates back even as far as January 2020. You can see here on this chart that back in January 2020, home builder sentiment was moderate. All the way through March, still moderate, but we see a giant decrease in April. And most of us know this is when the economy was shut down and there were a lot of people not working, staying at home, locked in because of the pandemic. Well, we go on to see a uptick and an increase in May, back in June, and at the peak, November 2020, the home builder sentiment was at its highest peak, right? And this is because they're recognizing, wow, these rates are super cheap. People can get into homes at a really low price. And not only that, but there's a lot of people leaving these other states to come to new states where states are wide open and there's more opportunity for business. Now, that's November 2020. So since then, it's been on quite an uptrend. the most important thing to understand here is all the data has really exceeded what we saw in 2020, going from January 21 all the way through even April of 22. Now, around this period is when we start to see interest rates start to climb. And as the interest rates continue to climb and the economy starts to get worse with inflation and things like that, the Fed gets really aggressive in raising the rates and home builders become skeptical. Rising interest rates affect the broader economy, but more specifically for home builders, if you're looking to build new construction homes and you're looking to provide enough supply for homes to be sold, you're going to feel a little bit skeptical when rates are climbing up at record pace. Now we see in December, it was at a bottom similar to what we saw back in April 2020. So we went from 30 for home builder sentiment score to 31 in December 2022. Well, now January up to 35, February up to 42, 44 in March, and 45 this month in April. Now, again, this is sentiment. This is saying how their confidence is in the rest of the housing market. But this is a very important sign because, again, with very low inventory, with limited sellers wanting to sell their own homes, low interest rates, and all sorts of things, you have home builders who are going to probably take a giant slice of the market share. There's still a lot of people that want to buy. So when rates start to change and start to go down, even faster than they're going down currently as I make this video, as rates start to change, these home builders will be at a very advantageous position because they'll be able to supply the market and get a big share of those buyers. For the fourth straight month, builder confidence has increased due to lack of resale inventory despite elevated interest rates, which is what we just talked about. There's not a lot of homes going back up for sale. Recent data from Realtor.com showed there were nearly 60% more homes on the market in March compared to the same month last year. But inventory levels still stood more than 50% below what prevailed during the years leading up to the pandemic. And again, important to understand that, right? Inventory levels are still a lot lower than they were before the pandemic. Even when these rates were starting to come down, the inventory was still not climbing up to that 6-month mark that we need to see it really start to even out for buyers. Currently, 1/3 of housing inventory is new construction compared to historical norms of a little more than 10%. And again, that goes to prove the point, right? If about 1/3 of the inventory on the market is new construction, that's 33% or so, 30% or so of the market share going to builders. That's huge. More buyers looking at new homes along with the use of sales incentives have supported new home sales since the start of 2023. And while acquisition, development, and construction loan conditions are tight, there is not significant evidence thus far that the pressure on the regional bank system has made this lending environment for builders and land developers worse. Meaning that all the banking failures and banking crises that we've seen, Silicon Valley Bank and others, Credit Suisse, these bank systems and failures that we've seen have not really impacted the lending standards and the opportunities for these developers and new construction builders to get into this market, right? And to actually have success in it. And as it says here in the beginning, more buyers looking at new homes along with the use of sales incentives. So again, that comes to closing costs, seller concessions, all the things that these home builders can offer. And all they have to do is trim off a little bit off their margins, knowing that they're going to be able to sell these units. They're still going to be making a good amount of profit. And this is also why Wall Street has reportedly been very high on investing in home builders this year. Another major factor contributing to stronger optimism among home builders is the modest pullback in rates seen in recent weeks. The average 30-year mortgage rate stood at 6.27 last week, down from closer to 6.75. So nearly a 50 basis point loss in mortgage rates, which is phenomenal. And it says here, even as rates were nearly 7% in late 2022. And just to review this chart with you guys, right? These are mortgage rates, okay? And a lot of people, if you don't already know, a lot of people may know this, but mortgage rates historically at even 5 or 6%, that's actually quite normal, right? Over the last few years, if you look at like the initial crisis that happened in 2008, these rates started to come down and down more and more. And it got to a point where a lot of us were conditioned to rates lower than 5%. And, for someone who may be a Gen Zer and maybe they, are looking to get into real estate and maybe they've been around since 2003, for the most part, they don't understand anything less than or more. They don't understand anything more than about 5% on interest rates. So yeah, rates are relatively high, but when you look at history, the rates really aren't that high. And if you look here, when the pandemic hit, this is when rates really started to come at its lowest point where it was so cheap to borrow money. So, and these are the 30-year fixed rate mortgages. Builders note that additional declines in mortgage rates to below 6% will price in further demand for housing. Nonetheless, the industry continues to be plagued by building material issues, including lack of access to electrical transformer equipment. Now, what they're pointing out here is that even with rates, as rates keep coming down, what will happen? More buyers will want to enter the market. They're going to catch wind of, oh man, now rates are down. Let's get into the market, right? Well, as a result of that, we have very, very, very low inventory. So prices have to stay up now because the demand exceeds the supply. But they also talk about here how there's building material issues and things that could still get in the way of these home buyers seeing that success. In the rest of this article, they talk about the National Association of Home Buyers measure of current sales conditions increased in April, and sales expectations for the next 6 months rose, marking the first time these components of the report came in above 50 since June 2022. Meanwhile, the gauge of upcoming buyer traffic was unchanged. Builder sentiment in April climbed across all regions in the Northeast, Midwest, South, and West. So this really tells us a lot about how home buyers are feeling in the current market. If you guys have any thoughts or feedback on where home builder sentiment is, are these home builders being overly confident? Is there another factor or something that will come up that we're not thinking about and that we're not considering? If so, please leave a comment down below and share those thoughts, as I'm sure other people viewing this video would love to see those opinions. If you found this information and breakdown helpful, please go ahead and drop a like on the video. I do breakdowns like this in my weekly newsletter that I send out that's completely free, where you can get up-to-date real estate news each week, just from my perspective and my view. So we need to talk about institutional homebuyer Yield Street and why they haven't really budged on buying a whole lot of real estate just yet. All right, so and this article starts off, this is an article by Lance Lambert over at Fortune. And he writes, heading into 2023, Yield Street told Fortune that the firm had reduced its home buying levels by more than 90% as the institutional home buyer awaited steeper declines in home prices. Yield Street told Fortune that the firm had reduced its home buying levels by more than 90% as the institutional home buyer awaited steeper declines in home prices. Which this is true, there's not as much, or there hasn't been as much institutional home buying going on. A lot of home buying that was happening was through institutions and big companies, and they would use LLCs to help buy these properties. From December onward, the expectation from my side is From December onward, the expectation from my side is we'll have another 10 to 15% decline in home prices nationally. The director of single-family residential at Yield Street, which owns over 700 single-family homes. We're pretty much on pause across all strategies. Fast forward to April, and many regional housing markets have actually, at least for now, stabilized. Among the nation's 200 largest housing markets tracked by Zillow, 23% of markets, including places like Austin and Reno, posted month-over-month home price declines in April. Meanwhile, 77% of regional markets like Columbus and Miami posted month-over-month home price gains in April. So, around 23% of home markets are seeing price decreases and price declines as of this month, whereas the other 77% or so have seen price increases this month. Do signs of life in the U.S. housing market have Yield Street ready to jump back in? So to find out, they called up this investor who works for Yield Street. I don't think prices have bottomed yet. On average, we have another 5% decline nationally, and it'll vary by market. Peak to trove, we're expecting 12 to 15% decline. However, he acknowledges that the over 20% peak to trove national decline he was expecting last year now appears unlikely. So this Yield Street investor guy feels that right now, the pace we're going, the expected 20% decrease that he was expecting doesn't really seem as likely as it did before. So if this is a big investor saying this, if big investors feel like the declines probably won't get as worse as they thought, then that shows you that they're probably gearing up and getting ready to make a move soon to buy up all these homes. And the more that these big institutions and investors buy up these homes, the less homes are available for people like you and me. And the higher premium and price we have to pay to be able to buy these homes for people like you and me. Yield Street hasn't bought any single-family homes this year through March, Joshi said. That's despite the fact that, according to Joshi, the company would like to grow its single-family home portfolio from its around $200 million value right now to $1.5 billion over the next 5 years. So wrap your head around that. This is one institution that wants to have $1 billion portfolio, and there's many others over the next 5 years that are going to be buying more and more real estate. And again, making it harder for the smaller people like us to be able to compete in this market. If the company goes through with it, that would mark a 650% increase in its single family holdings by 2028. The expectation that the home price correction will come back later this year with vengeance isn't the only reason Yield Street isn't buying homes right now. It's also about interest rates. So there is a big belief that home price buying and buying new homes will make a comeback by the end of this year. Of course, there's a lot to be determined. There's a lot of things that need to happen first before we get to that point. But they go on to talk about how interest rates is one of the big things. The average 30-year fixed rate mortgage, which peaked at 7.37% in early November, has come down to 6.5% as of last Friday in April. However, interest rates on floating loans offered to firms like Yield Street are still in the 7 to 8 percentile. Those high interest rates coupled with high home prices mean that buying a new single-family rentals doesn't make a lot of sense right now for institutional investors. So again, if you're one of these institutions, these floating rates that you're offered through lenders is not that attractive when you consider how much you're also paying for the home. So this is leading them to still be sitting on the sidelines and waiting. So according to Joshi at Yield Street, they're waiting for either home prices to fall further or interest rates to come back down or both. So think about this. What is the average American waiting for? Either home prices to come down or interest rates to come down. The only difference is the average American isn't working with billions of dollars of capital to be able to leverage and buy all these deals, right? To buy these single family homes for rentals. The big difference is that the average American is looking to buy one of these homes. But the more that us average Americans wait, the more these institutions wait. When they feel it's a good time to buy, they're already going to be way ahead of regular people like you and me. And they're going to know, okay, this is the time. Let's do it. Let's invest, right? But if you're a regular home buying, if you're a regular person or just a normal family that just wants to buy a home, you're going to be battling these investors. You have to know better than these investors. And that's going to be the hard part for most people. If short-term interest rates came down back around 4%, and if home prices were about 15% lower than the peak last year, that is a valuation that supports the equity return that investors need to make. Yield Street isn't alone. According to an analysis conducted by John Burns, Research and Consulting, institutional investors bought 79% fewer homes in the fourth quarter of 2022 than in the fourth quarter of 2021. So again, these institutions, a lot of them are still waiting. They haven't bought yet. And you wonder why. It's because they're waiting for these prices to come down. They're waiting for things to level out and the rates to come down. And that's going to leave a lot of normal people like you and I in a really weird predicament. So if you're someone who's thinking about buying or considering buying, this type of information is information you should always be considering. What's the competition look like out there, right? Just because you're ready and it's the perfect moment for you doesn't mean that it's going to be the opportunity that you've been waiting for, right? So that's something that's very important to think about. So let me know what you guys think down below. Are these institutions waiting for interest rates or home prices? What will we probably see come down more first? And of course, let me know down in the comments below where you're at, what your situation is. Are you still waiting to buy? And are you ready for this competition? If you guys find this video helpful, please go ahead and drop a like. I do reviews like this on my newsletter every week. It's a free real estate newsletter that gives you guys all the up-to-date news on what's happening in the market. If you guys find this information helpful, you can also subscribe to that. It's completely free. Of course, I appreciate all the comments and love and the likes that you guys have been providing on our videos. Please feel free to also subscribe so you can stay up to date on when my next post comes out. And I look forward to talking to you guys in the next video. Peace.